The U.S. Treasury Secretary said on national television 3 days ago, he said that one specific law, a law that most Bitcoin investors have never heard of, would, and I'm quoting him directly here, give great comfort to the market. He didn't say maybe. He didn't hedge. The Secretary of the United States Treasury went on CNBC and made a direct causal claim between a piece of legislation and Bitcoin's price. The deadline to pass that law is 13 days from today. And here's the part that will make your head spin. The single biggest obstacle to that law passing is a man named Donald Trump, and specifically the Bitcoin ETF his own company filed for 2 days ago. This is the most important, most overlooked Bitcoin story of February 2026. And by the end of this video, you're going to understand it completely. What's up, everyone? Welcome back. If you're new here, this channel is where we take the most important, most data-rich developments in Bitcoin and financial markets, and we cut through the noise to give you actual analysis. No moon math, no panic, just what the data says. Today is February 16th, 2026, President's Day. U.S. stock markets are closed right now. Bitcoin is trading at about $68,700. And while most of the financial world is taking a long weekend, something is quietly unfolding in Washington that could be the most consequential event for Bitcoin this year. I've been watching this market for years. I've seen regulatory news come and go. But what Bessent said on CNBC on Thursday is different. When the Treasury Secretary of the United States makes an explicit call on a specific asset class tied to a specific piece of legislation, that is worth taking seriously. Here's our roadmap today. First, I'm going to set the scene. Exactly where Bitcoin sits right now, technically and emotionally. Then I'm going to go deep on the Clarity Act, what it is, why it matters, and why the next 13 days are genuinely critical. After that, we're going to talk about the macro data bombs dropping this week that could light the fuse. And then I'll walk you through all the scenarios, the good ones and the scary ones. Quick but important, I am not a financial advisor. Nothing I say is financial advice. Do your own research. Never invest more than you can afford to lose. We're here to educate, not tell you what to do with your money. Before we go, drop your prediction in the comments. Will the Clarity Act pass by March 1st? Yes? No? Or what's the Clarity Act? Let me see where you're at. Let's start with exactly where we are. Bitcoin is trading at around $68,700 as of today, February 16th. We hit an intraday high of $70,197 earlier this morning, briefly touching that psychological 70K level before pulling back. The 24-hour volume is $35 billion, which is actually healthy for a President's Day holiday. Market cap, $137 trillion. Bitcoin dominance, 60%. Now, the context around that $68,700 price is everything. On October 6, 2025, Bitcoin hit $126,210, the all-time high. That's only 4 months ago. In that time, Bitcoin has fallen 46%. Bitcoin has dropped 46% from its October 2025 all-time high of $126,210 to today's $68,700. For reference, Ethereum has dropped 58% from its all-time high of $4,146. That's a massive number. And if you're one of the people who bought somewhere in that range, whether you bought at 90K, at 100K, at 110K, I'm not going to pretend that's comfortable. It's not. But here's the context question that matters. Is this normal, or is something structurally wrong? The answer, based on the data, is that this is normal, not comfortable, but within the historical range. Every single Bitcoin cycle has included a post-peak correction. 2013 peak to trough, 84% down. 2017, 83% down. 2021, 77% down. The current correction from the October 2025 peak is 46% at the February low of 60,062. Historically, Bitcoin cycle corrections have gone deeper than this, but 46% is completely within the pattern. What's unusual is the cause of this particular correction, because unlike 2018 or 2022, which were driven primarily by crypto internal events, this correction is being driven largely from the outside, specifically 3 external forces. Force number 1, the macro backdrop. The Federal Reserve held rates steady at 3.5%, 3.75% on January 30th. Markets are pricing only 9.8% odds of a cut in March. And then on January 30th, the same day the Fed held, President Trump announced that Kevin Warsh would be his nominee for the next Fed chair. Warsh is known as a hawk, a strict monetary disciplinarian, someone who believes in higher real interest rates and a smaller Fed balance sheet. The market's immediate reaction? The dollar surged. Bitcoin fell. Equity volatility spiked. Force number 2, the February 5th liquidation cascade. On that day, Bitcoin fell through multiple key price levels in rapid succession. 80K, then 73K, then 70K, then a brief touch at 60,062. As Bitcoin broke through each level, it automatically triggered stop-loss orders and margin calls from over-leveraged traders. Each liquidation pushed prices lower, which triggered more liquidations. The total damage, $2.5 billion in long positions wiped in 24 hours. The crypto quant data that followed was chilling. Bitcoin's weekly MACD just hit its lowest reading in the asset's entire recorded history. That's a technical signal that has only appeared at major trend exhaustion points. Force number 3, and this is the one almost no one is connecting correctly, regulatory uncertainty. The Clarity Act, the crypto market structure bill that would define the legal framework for Bitcoin and digital assets in the U.S., has been stalled in the Senate for months. And that stall is directly keeping institutional capital on the sidelines. As Bitwise senior strategist Juan Leon put it, regulatory uncertainty over the Clarity Act is critical to continued institutional adoption. It faced setbacks in January, and if negotiations drag on without progress, uncertainty will rise, and investor sentiment could become more skittish. And then, 3 days ago, the U.S. Treasury Secretary walked onto CNBC and essentially said the same thing, that the Clarity Act is Bitcoin's most important immediate catalyst, and the deadline is March worse. So before we go into the data, let me just say this clearly. Bitcoin is at $68,700 today, not just because of market forces. It's at $68,700 because 3 converging pressures, Fed policy uncertainty, a massive liquidation event, and a regulatory deadlock, have been pushing it down simultaneously. Understanding all 3 is the only way to understand what happens next. Okay, let's talk about the Clarity Act, because I genuinely believe this is the most underreported Bitcoin story of 2026, and you need to understand it. What is the Clarity Act? The digital asset market. Clarity Act, or the Clarity Act for short, is a bipartisan bill in the U.S. Senate designed to finally answer a question that has plagued Bitcoin and the entire crypto industry for over a decade. Who regulates this stuff? Right now, the SEC and the CFTC have been in a regulatory tug-of-war over crypto. The SEC claims that most crypto tokens are securities and fall under its jurisdiction. The CFTC claims Bitcoin and some other coins are commodities and fall under its jurisdiction. The result is a complete legal gray zone where nobody, no company, no exchange, no institution, knows with certainty what rules they're supposed to follow. The Clarity Act would fix this. Here's how it would work in plain English. Bitcoin, along with other digital assets that are sufficiently decentralized, would be classified as a digital commodity. The CFTC would oversee spot markets. Companies would finally know which regulator to work with, which rules to follow, and how to structure products. The legal uncertainty that has kept hundreds of billions in institutional capital on the sidelines would finally end. Why does this matter for the price? Because institutional money needs legal certainty before it commits. Pension funds, endowments, sovereign wealth funds, they cannot deploy capital into an asset class where the legal classification is genuinely disputed. The Clarity Act doesn't just help crypto companies. It unlocks an entirely new tier of capital formation. Analysts estimate the Clarity Act, if passed, could unlock $5,100 billion in institutional capital that is currently sidelined due to regulatory uncertainty. The March 1st deadline, here's where it gets urgent. The White House has set a March 1st, 2026 deadline for crypto executives and banking chiefs to reach a final agreement on the specific details of the bill, particularly around stablecoin yield restrictions. This is the crux of the current dispute. On one side, major banks. They want stablecoin issuers to be prohibited from offering yield on stablecoins. Their argument? If stablecoins offer yield, they compete directly with bank deposits, creating financial stability risks. On the other side, Coinbase. CEO Brian Armstrong has been vocally opposed to the stablecoin restrictions. He said publicly, and I'm quoting, "I would rather have no bill than a bad bill." That stance infuriated Treasury Secretary Bessent. On CNBC last Thursday, Bessent called crypto firms blocking the bill recalcitrant actors and, this is real, told them to move to El Salvador. He also said bluntly that part of Bitcoin's current price volatility is self-induced by the industry's own internal conflicts. Let me read you his exact quote. This is the Secretary of the United States Treasury speaking about a specific cryptocurrency. Part of the volatility here is self-induced. There is a group of Democrats who want to work with Republicans on getting a market structure bill. It's called the Clarity Bill. But there are a group of crypto firms who have been blocking it. So in a time when we are having one of these historically volatile sell-offs, I think some clarity on the Clarity Bill would give great comfort to the market. That is extraordinary. A senior U.S. government official explicitly connecting crypto industry infighting to Bitcoin price suppression and publicly calling out specific industry players. That almost never happens. The political math. Now let's talk about the political clock because this is the detail that adds the most urgency. Republicans currently hold 218 seats in the House of Representatives. Democrats hold 214. That's a 4-seat margin, razor thin. The 2026 midterm elections are in November. Multiple analysts, including legendary investor Ray Dalio, have warned that Trump's pro-crypto policy window is genuinely limited. Bessent himself said it plainly on CNBC, "If the Democrats were to gain control of the House, which I don't see as a good outcome, then the prospects of getting a deal done will just fall apart." And he reminded people what happened to crypto under the Biden administration. It was almost an extinction event. Republicans hold just a 4-seat margin, 218-214 in the House. Polymarket shows 47% odds of divided Congress after 2026 midterms, which would effectively kill crypto legislation. Prediction markets are giving the Clarity Act a 62% chance of being signed into law in 2026, but only if the March 1 deadline is met. If that deadline passes without a deal, those odds drop dramatically. This is the time pressure. This is why the next 13 days matter more than any TA level, any on-chain metric, or any Fed meeting, because the March 1 deadline is not a suggestion. It's a political forcing function. The Truth Social paradox. And here's the wild card that makes this story even more complex. 2 days ago, Friday, February 13th, Trump Media and Technology Group filed with the SEC for the Truth Social Bitcoin and Ether ETF, a 60/40 Bitcoin and Ethereum fund in partnership with Crypto.com, with a 0.95% management fee. Now, why does that matter for the Clarity Act? Because Senate Democrats have been citing Trump's personal financial ties to the crypto sector as a reason not to cooperate on bipartisan legislation. If the President of the United States is financially benefiting from crypto through his media company, which is filing for Bitcoin ETFs, then passing crypto-friendly legislation looks like the President writing laws to boost his own net worth. That's a political problem, not necessarily a legal one. But in the current environment, optics matter enormously for securing the Democratic votes needed for Senate passage. So here is the strange paradox at the heart of this story. Donald Trump, the president most publicly associated with supporting Bitcoin, may be one of the biggest unintentional obstacles to the law that would benefit Bitcoin most. Not because of policy, because of perception. Hit like if this is the first time you've heard the Clarity Act framed this way. Seriously, this connection barely exists in mainstream coverage. And subscribing is how you make sure you hear about these things before they move the market. All right, layer 2 of this story, the macro environment, and specifically the 4 data events dropping this week that could dramatically move Bitcoin. I want to start by explaining why this week matters so much. Today is President's Day. U.S. stock markets are closed. Traditional financial markets have thinner than usual liquidity. Bitcoin, however, trades 24/7. It never closes. And here's the historical pattern. When traditional market liquidity is thin and then suddenly a major economic data release hits, Bitcoin tends to experience amplified price moves. The shock absorbers are gone. This week, 4 major shocks are coming. Data bomb 1, FOMC minutes, Wednesday, February 18th. On January 30th, the Federal Reserve held rates steady at 3.5% to 3.75%. Not a big surprise, but the full minutes of that meeting, including the internal debates, the inflation risk assessments, the labor market discussions, get released this Wednesday. Why does this matter? Because markets are currently pricing only 9.8% odds of a March rate cut. That is historically low confidence in near-term easing. The FOMC minutes will either validate that hawkishness, in which case Bitcoin faces headwinds, or hint at more internal disagreement than the market expects, in which case rate cut bets could start coming back. CME FedWatch. 9.8% odds of a March rate cut as of February 16th, the lowest cut probability in over 2 years. The reason rates matter so much for Bitcoin right now is something called the risk-asset correlation. Over the past 18 months, Bitcoin has been trading increasingly like a high-beta tech stock. When the Fed signals higher for longer, capital tends to rotate away from risk assets, including Bitcoin, and into bonds. When the Fed signals relief, the opposite happens. A hawkish tone in the FOMC minutes would likely push Bitcoin back towards $65,000 or lower. A dovish surprise, anything that raises cut expectations, could be the catalyst that breaks Bitcoin back above $70,000 and toward the $72,000 resistance level. Data bomb 2, initial jobless claims, Thursday, February 19th. Thursday's jobless claims report measures how many Americans filed for unemployment benefits in the week, ending February 14th. The consensus expectation is around 220,000. The prior reading was 227,000, slightly above consensus, with winter storms blamed for the higher number. Here's the Bitcoin connection. The Fed's dual mandate is stable prices and maximum employment. If jobless claims come in below 210,000, signaling a robust labor market, that reduces the pressure on the Fed to cut rates. Bitcoin gets another headwind. If claims come in above 230,000, signaling softening employment, the Fed pivot narrative reignites, and risk assets, including Bitcoin, could get a lift. The range of outcomes here is genuinely wide, and in a thin holiday week, a 10,000 claim miss from consensus could move Bitcoin 3 to 5% in either direction. Databomb 3 and 4 Q4 GDP revision, plus PCE inflation on Friday, February 20th. Friday is the big day. Two reports are dropping simultaneously. First, the Q4 2025 GDP revision. This tells us how fast the U.S. economy actually grew in the final quarter of last year. A downward revision, meaning the economy was weaker than initially thought, would raise recession fears, but also raise Fed cut expectations. Net effect on Bitcoin, uncertain, but probably slightly positive due to the policy implication. More important, the December PCE inflation data. PCE, personal consumption expenditures, is the Fed's preferred inflation measure. It's the one they watch most closely. If December PCE comes in hotter than expected, above 2.5%, it validates the higher for longer narrative and could send Bitcoin down towards $65,000. If PCE is tame or declining, 2.3% or below, it revives the rate cut story and could spark a Bitcoin rally. The tariff situation adds another layer of complexity here. Trump's tariffs are still live. Tariffs are inflationary by nature. If PCE data starts showing tariff-related price increases, the Fed's hands are even more tied. That's bearish for Bitcoin. The Fed held rates at 3.50%, 3.75% on Jan 30. Combined with Kevin Warsh's nomination, hawkish, wants higher real rates and smaller balance sheet, Bitcoin is facing the most uncertain Fed environment since 2022. The Kevin Warsh factor, a deeper look. I want to spend a moment on Kevin Warsh because the conventional wisdom is getting this partially wrong. The initial market reaction to Warsh's nomination was simple. Hawkish Fed chair equals bad for risk assets equals bad for Bitcoin. And that reaction drove some of the early February selling. But Bitwise advisor Jeff Park made a more nuanced case. He wrote that if Warsh aggressively reduces the Fed's balance sheet, which Warsh has advocated for, it could cause what Park calls catastrophic repricing of duration assets, meaning U.S. Treasury bonds, mortgage-backed securities, anything with long-duration yields, they suffer. In that scenario, capital flows out of the traditional financial system seeking alternatives. And one alternative, historically uncorrelated to sovereign bond markets, is Bitcoin. Put simply, Warsh's hawkishness could first be bad for Bitcoin and then be very good for it. The short-term and long-term implications are different, and CoinDesk notes something worth knowing. Warsh has actually invested in crypto startups, including Bitwise itself, and an algorithmic stablecoin project called Basis. He's not hostile. He's cautious and pragmatic. Warsh is not a crypto evangelist, but has expressed a nuanced, pragmatic stance on innovation and regulation. Analysts view him as cautious about private crypto volatility and more focused on systemic financial stability. Myth-busting section. Myth. Bitcoin is failing as digital gold because it fell while gold rallied. Reality. Gold has been trading as a safe haven because of tariff uncertainty and geopolitical stress, a scenario-specific bid. Bitcoin's sell-off was driven by leverage liquidations, ETF carry trade exits, and regulatory uncertainty. These are different causes. The Bitcoin is digital gold narrative is about long-term non-sovereign store of value, not short-term safe haven during tariff panics. Myth, Trump's crypto support guarantees legislation. Reality, presidential support helps. But the actual legislative work runs through 218 Republican House votes and 60 Senate votes. Trump's personal business conflict with the crypto ETF filing actually complicates bipartisan outreach. Support at the executive level does not equal guaranteed legislation. Myth. Bitcoin ETF outflows mean institutions hate Bitcoin. Reality. According to Bean Crypto, the outflows are largely from U.S. investors rotating into international equities, not abandoning crypto permanently. The U.S.-specific macro environment, tariffs, Warsh, rate uncertainty, is driving that rotation. When macro clarity returns, the rotation can reverse. Let's map out the territory. What are the key levels, the key dates, and the real scenarios? Critical price levels to watch. On the downside, the $68,000 level is right where we are now. It's acting as both support and resistance in the short term. A meaningful close below $68,000 on daily candles would likely see a test of $65,000. Below that, $60,000, the February 5 low, which is structural support and a major psychological level. Below that, $53,000, which is the measured downside target from the current wedge triangle pattern forming on the short-term chart. And yes, I have to mention the Stifel analyst call for $38,000. That's based on a technical extrapolation from the 365-day moving average breakdown, the first such breakdown since March 2022. It's a tail risk, not the base case. But I said I'd give you both sides, and there it is, on the upside. The immediate resistance is $70,000, tested and rejected multiple times this week, including this morning. Above that, $72,000, which was a prior support level that became resistance. If Bitcoin can get a sustained close above $72,000, the next technical target is $82,000. That's the measured breakout target from the ascending triangle forming on the 4-hour chart, as identified by Crypto Daily's technical analyst this morning. The wedge triangle pattern currently forming on Bitcoin's chart has a 2 to 3 day resolution window. Bull breakout target, $82,000. Bear breakdown target, $53,000. The FOMC minutes on Wednesday may be the trigger. Scenario matrix, 4 possible outcomes this week. Let me walk you through 4 distinct scenarios based on the 2 biggest upcoming catalysts, the FOMC minutes on Wednesday and the March 1st Clarity Act deadline. Scenario A, dovish Fed plus Clarity deal progress, most bullish. If Wednesday's FOMC minutes hint at internal Fed debate or concern over slowing growth, and there are credible signals that the March 1 Clarity deadline is being met constructively, Bitcoin could break decisively through $70,000 and target $82,000. This scenario could also reattract institutional ETF inflows that have been consistently negative in 2026. Scenario B, hawkish Fed, plus Clarity, deal progress, neutral bullish. If the FOMC minutes reinforce higher for longer, but the Clarity negotiations show progress, Bitcoin likely consolidates in the $65,000, $72,000 range. The regulatory news provides a floor, the Fed data provides a ceiling. Expect choppy, sideways to slightly up price action. Scenario C, dovish Fed, plus. Clarity breakdown, neutral bearish. If the Fed sounds more accommodative, but the Clarity negotiations collapse, Coinbase walks away, Democrats disengage, the March 1 deadline is missed, Bitcoin could initially rally on the Fed news and then reverse. Longer term, the regulatory uncertainty vacuum returns and institutional adoption stalls. This scenario is particularly dangerous because the initial rally masks the structural damage. Scenario D, hawkish Fed plus. Clarity breakdown, most bearish. This is the scenario where the $53,000 measured move becomes likely and the $38,000 stifle call starts getting taken seriously. Simultaneous higher for longer. Fed signals and a collapse in crypto legislation would remove both of Bitcoin's near-term catalysts simultaneously. In this scenario, Canary Capital CEO Stephen McClurg's prediction of $50,000 in the summer looks well supported. Which scenario is most probable? Based on the current political signals, I'd rank them B, 35%, A, 30%, C, 20%, D, 15%. Scenario B, muddle through, is the base case. But the tails here are fat. The 30% chance of a genuine breakout and the 15% chance of a genuine collapse are both real. Key dates and catalysts, calendar. This week, FOMC minutes Wednesday, jobless claims Thursday, PCE plus GDP Friday. As I said, any one of these could be Bitcoin's next catalyst. March 1st, the Clarity Act framework deadline. This is the most important date for Bitcoin's structural future. March-May, Kevin Warsh Senate confirmation hearings. His testimony about crypto, about the Fed's balance sheet, about interest rates will provide critical clarity on the monetary policy outlook for the rest of 2026. Spring, late March to June. Bessent's stated target for the Clarity Act to be on the president's desk. If the March 1 deadline is met, a spring signing is possible. Q3 2026. Canary Capital's Stephen McClurg has pointed to summer as the potential cycle low, around $50,000, before recovery. This timeline is consistent with Bitcoin's historical 4-year cycle pattern. November 2026, midterm elections, the single biggest political wildcard for the entire Bitcoin regulatory landscape. What to monitor, starting tomorrow. Here's your practical watch list. 5 things to track closely. 1. FOMC language tone on Wednesday. Look for the words balanced risks, dovish, versus upside inflation risks, hawkish. That distinction will move markets. 2. Jobless claims number Thursday. Below 2 out of 10K equals hawkish signal. Above 230K equals dovish signal for rate expectations. 3. Any Clarity Act news. White House statements, Coinbase statements, Senate floor activity. Given the March 1 deadline, news can break any day. 4. Bitcoin daily close relative to $68,000. 3 consecutive daily closes below 68K would be a meaningful technical deterioration. 5. ETF weekly flow data. Farside, CoinShares published Fridays. A return to positive weekly ETF flows would be the first institutional re-entry signal. Okay, here's what I want to leave you with, the big picture. The insight that I think explains everything we've talked about today. Bitcoin is at a hinge point, not just a technical hinge, a historical one. In every prior Bitcoin cycle, the primary catalyst for recovery was internal. The halving supply shock, whale accumulation, retail FOMO. The cycle was self-referential. Bitcoin moved because of Bitcoin. What's different in 2026 is that Bitcoin's fate is now partially in the hands of people who didn't exist in Bitcoin's ecosystem 2 years ago. The U.S. Treasury Secretary is commenting on Bitcoin's price. The U.S. Senate is debating a bill that will define Bitcoin's legal status. A sitting president's media company is filing for a Bitcoin ETF. Wall Street's largest firms have $96 billion in Bitcoin ETF assets. Bitcoin has graduated, and like any graduation, it comes with complications. The Clarity Act is, in some ways, Bitcoin's bar exam. Pass it, and institutional capital flows in, legal certainty exists, and the asset matures into a legitimate global financial instrument. Fail it, and the regulatory gray zone continues. Institutions stay cautious, and Bitcoin's next recovery relies primarily on retail sentiment and the 4-year cycle. Both paths lead to Bitcoin's long-term thesis remaining intact. Bitcoin is 46% below its ATH right now, but it's still a $137 trillion asset. It still has a fixed supply of 21 million coins. It still processes transactions without asking any government for permission. Those fundamentals haven't changed. What has changed is the timeline and the pathway. The Clarity Act could compress the recovery by months. Its failure could extend the bear phase well into the summer, as Canary Capital expects. And here's the thing that I think most retail investors aren't accounting for. We have more information about what's driving this cycle than we've ever had in Bitcoin's history. We know the key dates. We know the key actors. We know the key arguments. The Treasury Secretary literally went on TV and told you what the catalyst is. Most cycles, retail investors were flying blind. This time, the map exists. Whether you use it and how is entirely up to you. All right. 5 key takeaways from everything we've covered today. Takeaway 1. The Clarity Act is Bitcoin's most important near-term catalyst, and almost nobody is watching it. Treasury Secretary Bessent explicitly linked this legislation to Bitcoin's price on CNBC. The March 1 deadline is real. Track it closely. Takeaway 2. This week's macro data will move Bitcoin. FOMC minutes, jobless claims, PCE inflation, and GDP. 4 data releases compressed into 3 days, hitting during thin holiday week liquidity. The volatility setup is fully loaded. Be ready for both directions. Takeaway 3. The Truth Social ETF filing is a double-edged sword. It signals expanding mainstream adoption, but Trump's personal financial interest in crypto is a genuine political complication for the very legislation that would benefit Bitcoin most. Politics and markets are now permanently entangled in Bitcoin's story. Takeaway 4. Bitcoin's technical picture is genuinely ambiguous, and that's honest. RSI at 3554, MACD at historical lows. A wedge pattern resolving in 2-3 days. The range of outcomes is $38,000 to $82,000. Anyone telling you they know which way this breaks is lying. Takeaway 5. Bitcoin is 46% below its ATH with $1.37 trillion in market cap. It has survived 84% corrections before. Context matters. This is painful. It is not unprecedented. The 4-year cycle, on-chain fundamentals, and institutional infrastructure are more intact than at any prior cycle low. Nothing in this video is financial advice. Every situation is different. Consult a qualified financial professional. Do your own research. Never invest more than you can afford to lose. If this gave you value, please hit like right now. It helps the algorithm surface this to more people who need it, and it costs you nothing. And subscribe and ring the bell. When the FOMC minutes drop Wednesday, I'll be here with a real-time breakdown. You'll want to be subscribed for that. One last question to close. Bessent said the Clarity Act is Bitcoin's key catalyst. Do you agree, or do you think the Fed and macro factors are more important? I want to know your read. Leave it in the comments. I'll see you Wednesday. If you made it here, thank you. Genuinely. You're the reason I make these videos. The next video is going to be a full Wednesday breakdown of the FOMC minutes in real time. I'm going to watch the release with you and walk through exactly what the language means for Bitcoin. Make sure notifications are on. Also dropping soon, a deep dive on whether Strategy's 713,000 Bitcoin position is the greatest conviction trade of the decade or a disaster in slow motion. That one is spicy. You do not want to miss it. The Patreon link is below if you want the extended monthly research report. It goes much deeper than these videos and has the full scenario probability models. I'm also on X for real-time updates when news breaks between videos. Until next time, track the data, not the noise. Stay curious, stay patient. See you Wednesday.